we're gonna have this Thursday, Sunday.
All right, good morning. We're going to get started. We'll call our July 2024 meeting to order. This public meeting of the Philadelphia Board of Pensions and Retirement is being conducted in person in the board's conference room at the board's offices on the 16th floor of 210 Second. Pursuant to section 21-1503 of the Philadelphia Code, electronic recordings of this meeting will be made through Microsoft Teams conference technology and by an audio recording. The electronic recording will be available to the public online on the board's website without charge within 10 days. Please note that you consent to such recording by attending, participating, or speaking at this meeting. First order of business is a motion to adopt the rules that the board has used and approved for our in-person public meetings that are electronically recorded. The purpose is to help ensure that accurate and complete audio and audio-visual recordings of the meeting occur to comply with the code requirements. Item 1 is a motion to adopt these procedures. Motion has been made and properly seconded. Any discussion? Hearing none, we'll go to the roll. Brian? Renee? Approved. Marcia? Approved. Paul?
Approved.
Andrea? Approved. Billy?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Item 2, motion to approve the minute meetings from June 27, 2024 was made and properly seconded. Any discussion? Hearing none. Brian? Renee? Approved. Marcia? Approved. Paul?
Approved.
Andrea? Approved. Lily?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Item 3, motion to approve the consideration of 113 pension applications and 67 withdrawal applications is made and properly seconded. Any discussion? Hearing none. Brian? Renee? Approved. Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. That moves us into section 4. Case 4A, a motion to approve the service-connected disability benefits for Troy Richards is made and properly seconded. Any discussion on 4A? Hearing none. Brian? Renee? Deny. Marcia?
Deny.
Paul?
Abstain.
Andrea? Deny. Willie?
Abstain.
And Adam?
Abstain.
And Carol?
Abstain.
The motion fails 0 to 3 with 5 abstentions. Case 4B, motion to approve the service-connected disability benefits for Tiara Summers was made and properly seconded. Any discussion on case 4B? Hearing none. Brian?
Abstain.
Renee? Deny. Marcia?
Deny.
Paul?
Abstain.
Andrea? Deny. Willie?
Abstain.
Adam?
Abstain.
And Carol?
Abstain.
The motion fails 0 to 3 with 5 abstentions noted. Case 4C, a motion to approve the service-connected disability benefits for Edward Ashburn was made and properly seconded. Any discussion on case 4C? Hearing none. Brian?
Approved.
Renee? Approved. Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Lily?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Case 4D, a motion to approve service-connected disability benefits for Sean Dandridge was made and properly seconded. Any discussion on 4D? Hearing none. Brian?
Abstain.
Renee? Deny. Marcia?
Deny.
Paul?
Abstain.
Andrea? Deny. Lily?
Abstain.
Adam?
Abstain.
And Carol?
Abstain.
Motion fails 0 to 3 with 5 abstentions noted. Case 4E, a motion to approve service-connected disability benefits for Charles Durham was made and properly seconded. Any discussion on 4E? Okay, Brian?
Approved.
Renee? Approved. Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Case 4F, a motion to approve service-connected disability benefits for Leonardo Gutierrez was made and properly seconded. Any discussion on 4F? Brian?
Abstain.
Renee,
Deny.
Marcia,
Deny.
Paul,
Abstain.
Andrea, deny. Willie,
Abstain.
Adam, and Carol.
Abstain.
Motion fails 0-3 with 5 abstentions noted. Case 4G, the motion to approve the service-connected disability benefits for Cedric Jones was made and properly seconded. Any discussion?
Yeah, we have discussion. So on this case, the gentleman also has two disabilities. He's getting checked out for two different disabilities, the knee and the hand, right? So the knee, they consider they have degenerative arthritis. I get that. But the hand, they're saying, the doctors are saying, monitoring is saying that he can't use his hand, it's disabling, and it could be a hazard because he's gonna be in a fire. So as a police officer, the gentleman can't use his hand. So I'm trying to understand how they come about that he wasn't solely disabled. And this is a question for later, not for now, that if you have, if they're looking at you for two disabilities, they approve you for one and disable and say no to the other, then what do you do? That's just a question for me. Thank you.
You said you want to answer later, Carol?
If you got it now, you can go ahead.
Well, so it's one application for disability
Mhm.
regardless of how many injuries that you have.
Right.
And then the doctors, as you can see, the first two doctors do address both injuries and then they come to the conclusion.
Mhm.
Dr. Wyman also addresses two injuries and then he comes to the conclusion that one is due solely and one is not due solely.
Mhm.
So then it's the discretion of the board to put the weight on the determination of the doctors. So even, it could be 5 different injuries.
Okay.
But it's still one application for disability. Your person could be disabled for one of the injuries or all 5 of the injuries. If they're disabled, they're disabled. That would be the analysis.
Mm. Okay, we discussed it. All right, okay, all right, great. That's it, Jay. Thank you.
Thanks, Carol. Is there any other discussion on case 4G? Hearing none, we'll go to the roll for the motion to approve case 4G. Brian, Renee, deny. Marcia,
Deny.
Paul,
Approved.
Andrea, deny. Willie,
Approved.
Adam,
Approved.
and Carol.
Approved.
The motion passes 5-3. Case 4H, the motion to approve the service-connected disability benefits for John F. Williams was made and properly seconded. Any discussion on case 4H?
Yes, I would like to send that to a hearing panel because we would like to, have the applicant provide more information regarding this case.
There was a request for a revised motion to send case 4H to a hearing panel. Is there a second? A motion regarding a motion to approve the revised motion to send case 4H to a hearing panel was made and properly seconded. Any discussion? Hearing none, we'll go to the roll. Brian, Renee, Marcia,
Approved.
Paul,
Approved.
Andrea, approved. Willie,
Approved.
Adam, and Carol.
Approved.
The revised motion carries unanimously. Case 4I, the motion to approve the service-connected disability benefits for Rashawn Price was made and properly seconded. Any discussion on 4I? Hearing none. Brian, Renee, Marcia,
Deny.
Paul,
Approved.
Andrea, approved. Willie,
Approved.
Adam,
Approved.
and Carol.
Approved.
Motion carries 6-2. 4J, motion to approve the service-connected disability benefits for Abigail Rodriguez was made and properly seconded. Any discussion on 4J? Hearing none. Brian,
Approved.
Renee, Marcia,
Deny.
Paul,
Approved.
Andrea, approved. Willie,
Approved.
Carol,
Approved.
and Adam. Approved. The motion carries 6-2. 4K, motion to approve the service-connected disability benefits for Michael Walker was made and properly seconded. Any discussion on 4K? Hearing none. Brian,
Approved.
Renee, Marcia,
Deny.
Paul,
Approved.
Andrea, approved. Willie,
Approved.
Adam,
Approved.
and Carol.
Approved.
Motion carries 6-2. Case 4L, a motion to approve the service-connected disability benefits for Timothy Bass was made and properly seconded. Any discussion on case 4L?
Yes, respectfully, yes. Fine, this member wants to make sure he gets a declaration. It will be a financial loss for him if he accepts his service. So respectfully request that we decline this.
Thank you for that comment. Any other discussion on 4L? Hearing none, we'll go to the roll. Brian? Renee? Marshall?
No.
Paul?
Denied.
Andrea? Willie?
Denied.
Adam?
Denied.
And Carol?
No.
Motion fails 0-8. Case 4M, a motion to approve the service-connected disability benefits for Anthony Benson is made and properly seconded. Any discussion on 4M? Hearing none. Brian? Renee? Approved. Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Case 4N, a motion to approve the service-connected disability for Navarro Fisher was made and properly seconded. Any discussion on 4N? Hearing none. Brian?
Abstain.
Renee? Deny. Marcia?
Denied.
Paul?
Abstain.
Andrea? Deny. Willie?
Abstain.
Adam?
Abstain.
And Carol?
Abstain.
The motion fails 0-3 with 5 abstentions noted. Case 4O, motion to approve the service-connected disability benefits for Eden Garrett was made and properly seconded. Any discussion on 4O? Brian? Renee? Marshall?
Oh, approved, I'm sorry, approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Case 4P, motion to approve the service-connected disability benefits for Joel Gray was made and properly seconded. Any discussion on 4P? Hearing none. Brian?
Abstain.
Renee? Deny. Marcia?
Denied.
Paul?
Abstain.
Andrea? Deny. Willie?
Abstain.
Adam?
Abstain.
And Carol?
Abstain.
Motion fails 0-3 with 5 abstentions. Brings us to section 5, case 5A. A motion to approve the application for service-connected death benefits for John Garrow, the deceased, was made and properly seconded. Any discussion regarding 5A?
Quick, Jack. This member was at work at the time of this incident. And all throughout both doctor reports, they say probably can't work at the board right now. That's a definitive fact. And they see the discount is 32 years of fighting fires for the city. So I'd like to put this to a hearing time so that they have a chance to dig over deeper into this.
There's a request to send case 5A to a hearing panel. Is there a second? A revised motion was made and properly seconded to send case 5A to a hearing panel. Any discussion on the revised motion? Hearing none, we'll go to the roll. Brian? Renee? Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries 7-1. Section 6, case 6A, a motion to approve the application to appeal the revocation of a waiver for benefits regarding Aretha Hall, the deceased, was made and properly seconded. So this is consideration of appeal that the children filed.
So that's what I want to clear up. We're voting on the appeal by the children to deny it. That's what they're looking
To
for.
prevent the waiver.
That's what we're voting.
Yes.
I just want to be clear.
Yeah.
The children are looking to stop the revocation, and that's what we're waiting for. That's perfect. I'm pursuing to 22, 1901. Thank you.
But the children originally agreed to the revocation of the waiver.
The two other children, is the third child that waived the benefit and is now looking to revoke, the waiver. Not the third child, the third person.
Right,
So, yeah.
Yeah,
The third beneficiary.
yeah,
Right,
the fiance or,
So he waived,
He
money was going
waived
to the kids.
right,
Now he's revoking his waiver, so money's been going to him.
yes,
And now the kids are appealing the revocation. And if we deny, the money continues to go to all three of them.
right, but I'm
We
saying
approved
the
it goes
kids
back to-
originally signed off and agreed to them having the opportunity to come back and pull the revocation of the waiver. That's what the paper
it's
said.
not their waiver, it's his.
Well, his waiver, that's
They,
what
they
they
don't agree to anything.
they don't agree,
He originally chose to waive,
He
Yes.
chose to waive.
which that can be changed
yes,
at any time.
yes.
Correct.
Wait, 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 wait.
And such waiver may be revoked in writing at any time.
Is there any other discussion? I just want to make sure everyone is comfortable and understands what we're, okay. Hearing none, a motion to approve the application to appeal the revocation of the waiver for benefits was made and properly seconded. Any discussion? Go to the roll. Brian?
Deny.
Renee? Deny. Marcia?
Deny.
Paul?
Deny.
Billy? Adam? Carol?
Deny.
The motion fails 0-8. Moves us to old business, case 7A, a motion to approve application for service-connected disability benefits for Linda Long was made and properly seconded. Any discussion on 7A? Brian?
I approve.
Renee? Approved. Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
Carol? Approved. Motion carries unanimously. 7B, motion to approve the application for service-connected disability benefits for Kathy Raymer was made and properly seconded. Any discussion on 7B? Brian?
I approve.
Renee? Approved. Marcia?
Approved.
Paul?
Approved.
Andrea? Approved. Willie?
Approved.
Adam?
Approved.
Carol? Motion carries unanimously. Case 7C, a motion to approve the application for service-connected disability benefits for Felix Nosek, who was made and properly seconded. Any discussion on 7C? Hearing none. Brian?
I approve.
Renee? Marcia?
Deny.
Paul?
Approved.
Andrea? Approved. Lily?
Approved.
Adam?
Abstain.
And Carol? Motion carries 5-2 with 1 abstention. And case 7D, motion to approve the application for service-connected death benefits regarding Suzanne Tucker. The deceased was made and properly seconded. Any discussion on 7D? Hearing none. Go to the roll. Brian?
I approve.
Renee? Marcia?
Deny.
Paul?
Approved.
Andrea? Approved. Billy?
Approved.
Adam?
Abstain.
And Carol? Motion carries 5-2 with 1 abstention. That moves us into new business.
Morning, everyone. Staff has been working with the city chief technology officer and his folks to evaluate various businesses processes. Cover benefits, possible enhancements and efficiency of the technology. So, looking to go IT, the chief technology officer, we think this is an essential step. Before we get to the next steps, and possibly RFQ to determine what's out there in the marketplace that will work efficiently with what the city uses for HR, payroll, so on and so forth. Something that obviously is for the precursor to determine whether or not we should enhance the system. Fiduciary duty and proxy education extravaganza coming soon in the fall, right? We We all received an email from Josh yesterday on that, and it also, included the proxy education. And the hope is someone from our proxy company, Marco, will also be there. And following that seminar, we're going to be, we'll do a number of things, but one of the other things we'll have a proxy subcommittee shortly thereafter, right on the heels of that. So we give it a good time. The law department, we received the law department is restructuring somewhat as it concerns pensions. There's a new finance pension group, and here today is Rubin is on. Please tell me if I mispronounced your first name. He is the divisional deputy in charge of that finance pension unit. There still will be discussions with the law department as what will constitute that unit and how it will affect the board of pensions. We know that Adam will be shifting over to a different role. I think there's some backfilling to take place. I'm not sure what the effect on Ellen will be, but we'll have to discuss that with the law department. I would like one of the elected trustees to be involved in those discussions to ensure that the board is properly represented in that restructure. So, Brian, I don't know if you want to do it, or whoever. So just at least have one because it's essential. We'll have discussion with everything. Okay. The MES, the medical provider, we have begun, we met with them, as I told you, we met with them, visited their site, reviewed their process overall, staff goes. They have begun receiving cases / applicants for review. The intake process is excellent. They have an excellent intake process. We know the staff here has been able to work very, very well with them. They have been educated in the code and what the service connected disability process criteria are. I guess we'll really be able to make a determination when we see our first report. So far, so good. So we'll keep you posted on that. The number of service connected disability applicants continues at a high rate, just to let you know, as you can see in the board meetings. We appreciate your participation. In fact, participation is essential. And that really goes for every member of the board, every trustee. We need every trustee to participate in that because it is for the members, it is for the city employees. So it's very important. We will continue to receive emails and requests for participation in hearings. Also, you may see a large number of people in the room today. We have intern groups from Exponent, formerly FIS, Tina Biles Williams, we worked with for years, so a number of interns here. I'm sure you hear most of the financial part of the meeting, which is taking place next. But I hope the benefits of meeting was interesting to you.
Thank you so much for the fiduciary subcommittee. Yeah, we can do that, you're hired.
So we'll invite you back for Josh's seminar. If you can sit through that, you deserve the award. But anyway, thank you for coming. See some new faces here. That's all I have.
When did Josh come over me?
He sent out some dates yesterday.
Oh, yeah,
And I didn't see September 17th or the 19th. But obviously, there are two start dates. We can work around it. We want to make sure everyone's able to be there. So I know you had a possible conflict on those dates, but we want to make sure everyone's there because we think it's important.
You said we're losing Adam, is this it?
Yeah.
Not quite yet.
You gotta talk to me about that.
He's not going far.
He does good work. Did good work. If we do lose it, thanks.
We just have a lot of volume in our commercial offer.
Well, we're happy to have him on the contracting side.
Yes.
I have to say, he felt the pain. So we are happy to have him. Yeah.
Thank you. Looking forward to it.
litigation summary on any updates, notable updates?
We finally won Bentley or it's bet and
And with that, a motion to adjourn was made and properly seconded, and we're going to move into the deferred compensation.
I read it in the hours. I felt You got your money while you do
No, I'm sorry, I was waiting for principal. We'll take one after this. All right, the first item for deferred comp is approval of the minutes from June. Motion,
Okay, we're back in order now.
thank you, Vice Chair. Motion to approve the minutes from our June meeting was made and properly seconded. Any discussion? Hearing none. Go to roll. Brian? Christie? Francois?
Approved.
Marcia? Approved. Paul?
Approved.
Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. That moves us to the fan update and activity report.
Good morning, everyone. So as of the end of June, City of Philadelphia First Comp Plan had an ending balance of $1,980,997,051. Total plan participants are 25,999. 19,945 of those are actively referring into the plan. And there are 156 new enrollments during the month of June. As this is the end of June, I just wanted to quickly year to date, that's 1,097 enrollments for the year as we're halfway through. If you recall, we did the annual plan review, we discussed the goal of 2,000 for the year. So we are ahead of that for the year so far. Philadelphia Parking Authority is 632 participants in the plan. There's one new enrollment received in the month. The 401A plan is $3,564,130 with 1,130 participants. 2,354 participants are utilizing the percentage contribution option, an increase of 33 since May. And 7,554 participants are contributing to the Roth option, an increase of 150 since June. I'm done playing Vina. I will turn it over to Brad. And the local team activity for the month of June was 161 individual one-on-one consultations, resulted in 97 enrollments with the retirement specialist for the month of June. 18 group events and workshops for the month with 474 attendees for the month. 16 of those one-on-one consultations were conducted using the My Interactive Retirement. Thank you very much.
I have one question. Do you know how many employees are in the Plan 16 who are not making a contribution in the first month?
That would be more of a question for
I guess one billion.
payroll.
Okay, all right, okay. And if I get that information, I'll share it with you because maybe we could break it down by department and union code. All right, so. Okay.
Absolutely. At the beginning,
I have a meeting with him today.
at the beginning of this year, we did a breakdown of,
Yes,
and we sent out an email to those folks that were not contributing,
yes.
that were eligible to receive the match.
Mhm.
We plan on doing that at least annually,
Okay,
just to kind of get that list and re-up that, to kind of get those folks engaged in saving for the retirement and getting the match if they deserve it.
okay.
Any other questions for Brad or Brendan? And Chris, we can list item 3.
Thanks, Jackie. Good morning.
Good morning.
This agenda item is a continuation of the discussion we had at the last 2 meetings regarding one of the investment options in the deferred compensation lineup, the Mass Mutual Mid-Cap Growth Fund. As a reminder, we used our software provider's database to run a screen of mid-cap growth funds with at least 100 million in total product AUM and a 5-year performance track record through the end of March of this year. We also considered short and long-term performance as well as the expense ratio. As we discussed, those searches led to what we considered to be weak options. We weren't really satisfied with other mid-cap growth options. So the other possibility we discussed with the trustees at the last meeting was to replace both the Mass Mutual Fund as well as the Companion Mid-Cap Value Fund from MFS with a single core fund that would be actively managed. Again, we set certain search parameters, as you can see laid out in the staff's report. That led us to a recommendation for the Eaton Vance Atlantic Capital Smith Cap Fund. You can note the expense ratio there, 82 basis points. If accepted, this core option will give the plan participants exposure to mid-cap core with opportunistic allocation to small cap. As you can see from the performance, it's provided strong returns over both the short and long term. It's only trailed and very, very slightly over the 5-year period. It's never ranked worse than 36th percentile amongst its peers. And if this was accepted, we would have the normal timeline with Nationwide in terms of sending out notice to the trust or to the plan participants, giving them opportunity if they wanted to move the money elsewhere, otherwise it'll be matched accordingly into this house. Happy to take questions, comments, concerns with that recommendation.
The MFS fund is a productive fund.
It is.
You could argue more productive than what we're going to replace it with, but then there's Mass Mutual, which is terrible. So there's no strategy you would think to keep the MFS or to keep both. I just want to.
So if you, and I understand the concern, you and I have talked about it, I think a couple others talked about it. If the desire is to keep the MFS fund, excuse me, then I would not be comfortable eliminating the growth option. So if the issue is then you're going to be left with an index option and just an active value option. You're not going to have a growth option. And what the trustees have done, I think very prudently throughout the plan, generally speaking, we have a value, we have a growth, and an index. Here, you would be changing that. If you're uncomfortable, then with that, then my fallback option or recommendation would be to wait. We can run the screens again at the end of the next quarter and see if there's anything that we feel more comfortable with. But I think the worst option would be to leave just a value, and an index, because value under, you don't have that balance. So if folks who want active management can't balance the two.
Personally, I trust your recommendations. The fund you're recommending is very productive as well, so I won't discount that at all. It's a great fund. If you're not comfortable with both, I think we'll move on.
No, it's a totally valid concern, and one, I was on vacation there with Kristen, we did a lot of work on this. We spent a lot of time talking about that. Ultimately, we felt this was the better recommendation.
So is that the same thing, just replacing that one manager?
So if this recommendation was accepted, we'd be replacing two.
I know, but I'm saying going back to,
Okay.
going back to the prior, and saying, can we just replace the one manager
You could, but that,
instead of doing two?
you could, but I'm less comfortable with that, because what that does is right now you have a mid-cap growth, a mid-cap value, and an index. If you just replace the one, what you're gonna be left with then is a mid-cap core, a mid-cap value, and an index. There's not gonna be a corresponding growth option for people who want to balance out their mid-cap exposure.
We can't replace it with the same type manager, I guess that's.
We've done searches now two or three times, and we're not comfortable with the funds that are showing up on the screens and then also available on the Nationwide platform. We don't think any of them, at least at this juncture, are proven options for the participants.
You said we can wait a minute and then
You
come
could,
back at
you could wait, if their comfort level, you could wait another quarter or, longer. Keep Mass Mutual, keep MFS, and then we can come back again in a time period, the trustees are comfortable. But I would not recommend just, as we discussed, Robert, if you asked Carol, just doing a swapping core for, growth. And then using the corresponding value option. I think that presents an imbalance just in that one part of the fund.
Can't see anything suddenly appearing on the radar in a quarter, it's not on the radar today, right? I mean, that's.
So if Nationwide, for example, if additional funds got added to their platform or something, that would be the most likely scenario, as opposed to a dramatic change in performance, which then we would analyze and say, well, that's really a short term. So the most likely scenario would be Nationwide.
Yeah. Wait
It
for
doesn't sound as though waiting would make too much.
Wait,
Waiting.
What you did, Jack?
Need a motion?
I'd like to see if there's a motion.
Yeah.
Staff
I'll make the motion to adopt staff's recommendation to replace the two funds we discussed on the record.
Okay, go ahead, Francois.
Motion to accept staff's recommendations made and thoroughly seconded. Any discussion? Hearing none, go to the roll. Christie? Brian? Francois? Marcia?
Approved.
Paul?
Approved.
Willie?
Approved.
Adam?
Approved.
And Carol?
Approved.
Motion carries unanimously. Why don't we take a 5-minute break, so then we'll move into discussions. Thanks.
Thank you.
They were good, so.
Session. Item number 1 is approval of minutes from June 27th. Motion. Been moved and probably seconded, minutes approved. Francois. Approved. Paul. Approved. Ryan. Approved. Billy. Approved. Carol. Approved. Martha.
Approved.
Adam. Approved. And Christie. Approved. Motion carries. Thank you very much. Turn it over to you guys.
Thank you. So in terms of the investment performance through the end of June, the end of the fiscal year, plan returned preliminarily returned 8.7%. Net of fees, which is 8 points ahead of the benchmark. That does include the use of lagged private equity data. So that
And even
number-
further ahead of the earnings.
Yes, preliminarily, I would think that any movement would be to the upside, where it remained, the number will remain relatively constant. We did get a couple of really large private equity distribution payments, and so, all in all, strong performance for the fund through this year.
When did you have final numbers?
So we will get updated March numbers for private equity in the next month or two. Probably be late in the calendar year. When those numbers fully settle. Also through the 23rd, month-to-date performance in July has been strong. The fund's up around 2.25%. So a strong start to this fiscal year. And so folks know we will send monthly estimates out or weekly estimates on Thursday as opposed to Wednesday, so that we capture the full month of July. In terms of individual managers, no actionable concerns from staff. Brandywine had a little bit of a rough month and has struggled somewhat, year to date. Go out further, obviously very strong performance. There's been a lot of volatility in currency markets, and again, we've seen this kind of volatility from them in the past. So again, no immediate concerns there. Again, no actual concerns on the equity side either. Ernest struggled a little bit for the month, and really solid performance for the 2.5 years they've been on the plan, up close to 500 basis points. Value has struggled a little bit recently, although that may be changing. I'll talk about that in a minute. So no real concerns about Ariel, Causeway. Capital Group had a little bit of a positive month, albeit protecting capital on the downside, and someone will continue to keep a close eye on. And global bond managers had a slightly down month versus the benchmark, but both outperformed since inception. Things that we're keeping an eye on, one I just kind of alluded to with value. Tech stocks have really undergone noticeable correction in the last week or so. Last Wednesday was the worst one-day performance for the S&P and NASDAQ since 2022. So we saw some of the bigger names come in with poor earnings, poor revenue, at least given market expectations. There's also some discussion about the amount of money some of these tech companies are spending on AI versus the initial kind of returns they're getting, not necessarily matching up, at least that would be short to medium term.
In the market, kind of back up.
Correct. Although it's been very volatile, there's also been a couple of days where the NASDAQ has done very well. So I think there's still a little bit of the market's still trying to figure out exactly what to make of tech stocks in their market. We'll also get some updates from the Federal Reserve tomorrow. There's a general market expectation that they'll hold the rate steady, but signal rate cuts ahead. I think there's a lot of, while September, I think a lot of folks feel is when it, I'll say it's justified, but I think there's a little bit of market uncertainty around that because they're not sure that the Fed will be seen as influencing the election. So it's possible that they'll wait till later in the year. They have historically, however, I want to say in 88 or 92, they cut rates in September. I believe it was maybe in 2000 or 2004. So they have done it before, but it's not common. I would anticipate they will, absent something dramatic, cut rates at least once, if not twice before. Consumer continues to be relatively strong, but the lower end of the market is showing some strain. Some of the earnings for some of the fast casual or fast food restaurants have not been particularly great. And so you see kind of the introduction of more kind of those fast food companies or fast casuals reintroducing like value type, options. Because the way folks are doing it now, I mean, food prices obviously risen dramatically over the past couple of years, but it's been even more pronounced in restaurants, not just fast food restaurants, but restaurants broadly. So you're seeing consumers start to come back, particularly on the lower to the middle end. So we are seeing, some signs of strain there. There's obviously a lot still going on geopolitically, China, Israel, Gaza, Ukraine that continues to have some short-term impact on oil prices and other things. And then China continues to show signs of a weakening economy, and I would say there's at least some consensus that the plans or the things they've talked about doing to get themselves out of their run haven't been all that enthusiastic about the markets and thinking it's so with that, happy to take questions. I don't know if Clayton or Dave have other manager comments or market comments they want.
No, from this thing, Chris covered everything.
We've all been reading the same stuff.
But you have special insight.
Yeah, we read all the words.
We stand.
And then just in terms of the the staff report, rather, the third agenda item, securities lending, income for the month, north of $124,000, $738,000 in change for the year to date, and $52.6 million in change since the inception of the program. Uptick in diverse and local AUM. On a combined basis, just north of 60%. Diverse managers in their own group, 50.91, and Philadelphia and surrounding counties, 9.82. Upcoming board meetings, the August meetings, 28th, reminder that we scheduled, and that's a Wednesday. And September 26th and October 24th.
So now we're to agenda item 4.
I'm gonna ask the question, Marquette to step out for a moment.
You're ready.
So this is the first of two consulting RFPs that we'll staff will be reviewing with the board over the next couple of months. This is for the general investment consultant opportunity. As you can see on page 2 of the staff report, the RFP was posted earlier this year. We received proposals from 5 firms. 2 of the firms were eliminated during initial screening because they did not require minimal RFP qualifications. In reviewing the remaining 3, we considered a number of factors, some of which are listed on page 2. Due diligence and research, staff availability, tools and resources, fees, etc. We also considered the firm's overall organizational stability. And then after hearing presentations, having follow-up discussions with the candidates, we invited incumbent Marquette and Veris to present today in front of the full board. I won't go through every part of the report in detail, happy to take questions, but just a couple things to note for each. You can see that both firms submitted revised bids that came down from their initial listed bid. Marquette at $670,000 for the 4-year period, Veris at $665,000. We provide client breakdowns and focus a little bit on their public pension and Taft-Hartley plans. You can see Marquette has 60 public pension clients, 114 in the union Taft-Hartley. Veris has 28 on the public side and 52 in the Taft-Hartley. So both firms have good experience with public and labor employee pension funds. Neither respondent or presenting firm listed any exceptions or concerns with the city standard contract language, which is always a plus in terms of negotiation, getting folks on board. Primary proposed teams are listed. You can see there would be minimal change on the Marquette side. You can see some of the names likely familiar to you on pages 4, 5, and 6. Veris, I'll just touch briefly. They did in their proposal talk about a few recommendations that they would likely make if they were selected. Again, these are high level, they're broad, they haven't had a chance obviously to discuss in depth with the board, but they talked about reducing some of the plan's equity risk, looking at foreign currency risk, hedging, currency beta, and other things that's covered in some detail on page 8. And then I'll just note on their primary proposed team, one of the folks out there.
Can you talk for a couple seconds about their proposals? We can get them.
Sure. So they made several, proposals again at a high level, and where I found myself, and talking to some of the folks on staff, again, Kristen, Brian, some others. So they had a couple proposals that I thought at a high level, I agree with. They're against adding additional money to core real estate, which I think is a proposal that's largely by staff. We've had some discussion with Marquette. They recommended eliminating the 1% allocation to public REITs, also real estate. I think that's a reasonable discussion to have, a reasonable suggestion. There were several, I guess 3 or 4 things they proposed that I disagreed with or had questions about. In their initial proposal, they entirely eliminated the allocation to cash, which I know is not something that's realistic, something that we discussed with Marquette. In follow-up conversations, they acknowledged that given our benefit payment structure, given some of the comfort level of the board, that it probably did make sense to keep cash. Again, that was their initial proposal. They also talked about they also talked about recommending another 5% allocation to private equity. I'm skeptical of that for a few reasons. One of which is the board continues to lower the assumed rate of return. So I'm not convinced that in the next 5 to 10 to 15 years, that much additional private equity would be needed. It also would be concerning around fees, because fees would also go up, perhaps considerably with that allocation. They also recommended increases, sometimes large, in private and multi-asset credit. I have identical concerns there around fees, around lockups. And it also, to some extent, reminded me, at least in a couple of the examples they provided, of the empowerment, the KKRs of the world, certain opportunistic credit things that we had shied away from. There was also some discussion of using hedge funds, which with one small exception was eliminated. They view it as a way to dampen risk. My experience, I won't speak for the board, but I think our experience has not been similar in terms of the use of hedge funds, at least historically.
More effectively.
Yes. And then, there was some where I would need more information, partially agreed, was more benign. They're not in favor of, as a whole, they would eliminate global involvement entirely. But
Good Marquette group.
they do not. But again, that's where they talk about some of the money goes to global equities. Okay, I could potentially support that, but then some of it would go to hedge funds, which I don't support, or I wouldn't support. They talk about some manager overlap in small cap and core fixed income. I don't believe the overlap is as pronounced as they do, and the managers by and large have done really well for us. In particular in fixed income, we don't have a wide roster of core fixed income managers. We only have 2 or 3. I'd certainly have the discussion if there's someone that we should eliminate or talk about eliminating, and we have to have the discussion, but I'm somewhat agnostic on that, and I'm kind of loath to eliminate managers who've done well for us, at least now. So somewhat of a mixed bag. I will, again, they have a very good team. The staff, or the reference calls we did with 2 other public funds, spoke very highly of Eurus. Samantha Grant, who used to work for Marquette, is one of the presenters today. She did a nice job on U.S. equities and some things when she worked for Marquette. So we do have a professional relationship with her. She's very, very sharp. But that's where we kind of came out and analyzed, at least initially, the proposals that they really had on.
How long are we giving this now?
20.
20?
Ask a question.
What?
Ask a question.
20, okay.
And you can talk about it.
It's gonna get that Major League Baseball pitch clock.
That's right. Ball one.
It's
What? Okay.
Thank you. Sure, sorry. You want to start with that?
No, you can be here for it.
Okay, number 5.
We're good.
Okay. Are you ready? Good. Like 15 minutes and then we'll look for questions. Whenever you're ready to go.
Should we jump in now?
Yes,
Okay,
please.
Thank you, Chair. And good morning, and thank you for the opportunity to present Veris's investment advisory capabilities. And more importantly, why we think we would be a great partner for the city of Philadelphia in managing the. My name is Mark Brubaker, and I would serve as co-lead on the relationship with the city of Philadelphia. Joining me on my far left is Shelley Heyer. She's our president from our Seattle office. And my other co-lead, Samantha Grant from Chicago. I'm going to give them a minute to that. You probably recognize Samantha. So I'm going to give them an opportunity to introduce themselves in just a minute. But before I jump into our presentation, first of all, I wanted to thank Chris and Vernon and the team for a really very well-run process. And we really enjoyed the interaction we had over the past several months, getting to know them and the team and getting to know more about your system. So that was good. I think you've already given me time, 15 minutes. We welcome any questions throughout the presentation, but if you prefer to wait until the end, we're fine with that too. So I'm going to give a call on that. So just to give you a quick background of me, again, I head the Pittsburgh office for Veris. I also serve on the management committee at Veris. I'm co-head of the public pension fund business at Veris and also a shareholder in the firm. I've got 35 years of experience working with clients like City of Philadelphia. I currently serve 4 clients as lead. The clients I work with right now would include Pennsylvania Public School Employees Retirement System, Tennessee Consolidated Retirement System, and the South Carolina Retirement System Investment Commission.
Okay. Good morning. My name is Samantha Grant. I am a senior consultant at Veris. I would serve as the day-to-day contact for the City of Philadelphia. I currently work with a number of public plans, including New Mexico Public Employees, the City of Springfield in Missouri, as well as Illinois Police. Internally, I serve on the investment committee. I co-lead the DEI committee, and I am a member of the public sector team with Mark.
And as Mark mentioned, I'm Shelley Heyer. I'm president of Veris. I'm a 24-year veteran of the firm as well, and also serve as a senior consultant. I'm here today primarily to represent Veris and assure you that this is the right team for you. And my job as president is to make sure that they have the resources and capacity to serve clients like you. We'll talk more about that.
Great. Thanks, Shelley. Before I go, and we're still on slide 2, before I go over to the next slide, I just wanted to point out some of the other support team members that will be actively involved in this relationship. Starting with Ian Toner at the top left there, he's our chief investment officer. He's highly respected in the industry, and you would see him from time to time in person or virtually, especially at times when we're talking about our capital market assumptions or doing an asset liability study for you. Farash Shani, who heads up our private markets team, is another one, and then Mary Ann Feely, who heads up our public markets research team as well, and Kelly Barkoff, who heads up our performance reporting team. They'll all be people that you deal with on a regular basis. If you go on to slide 3, I really wanted to touch on 4 key factors that we think not only differentiate Veris, but really make us an ideal fit for the city of Philadelphia. And to start first with an experienced team, Sam and I bring over 50 years of experience to the table. One of the things that we noted in this process that you've been working on what I would call not necessarily de-risking from an asset allocation standpoint, but de-risking the systemic risk in the portfolio by reducing your actuarial assumed rate of return, by really beefing up funding policy in other areas. And we work with numerous clients that are doing the exact same thing. So we have a lot of experience in helping build investment programs for those types of scenarios. Equally important, as we talked about, we need the capacity to serve. So Sam and I Shelley will talk later too about our commitment to maintaining a low client to consultant ratio. We work with very few clients, and our firm is designed to keep it that way. Specialized resources. There, we have a lot of best-in-class external systems that we use, but they're combined with internal proprietary models that we bring to bear, really to help our clients
achieve their return objectives while managing risk on an absolute basis, as well as relative to liabilities, benchmarks, as well, and peers as well. A customized approach. We offer no proprietary funds. Many of the firms in our industry have proprietary funds or are really focused on discretionary portfolios. We don't have model portfolios. We're an unconflicted firm, and investment advisory is our sole business. If you look across our public fund business, our clients take a variety of approaches, even those that are in the same de-risking mode as the city of Philadelphia. We have clients that have a traditional, 65-35 mix. We have clients that use heavy alternatives, clients that engage explicit leverage in their portfolio, as well as those that use functionally focused portfolios. So, we don't have any cookie cutter solutions that we bring to bear for clients. Every client has unique return objectives. Every client has unique risks, and one of the main things that we're going to do, and Sam's going to talk about this more, is we sit down with the board and really understand your enterprise risk tolerance and your objectives to make sure that our recommendations are in line with that. And then finally, and most importantly, deliver results. I mean, ultimately, you hire a consultant to help you drive returns on a risk-adjusted basis. Verisk has a 40-year history of doing this on behalf of our clients. And you'll see later in the presentation, our clients give us really strong ratings for service, responsiveness, and results, and we've had very low client turnover as a result of that. So with that, I'm going to turn it over to Shelley to talk a little bit more about the firm.
Great, thank you. I'll move you on to the next slide. There's a couple of highlights about Verisk listed on this page. One of the things that I think most of us mentioned in our introductions is that the three of us are shareholders, and we actually have 35 shareholders, very distributed ownership structure at Verisk, which means for this staff, for this board, who you have in front of you today is who will be here a few years from now and many years from now. That ownership structure provides stability and continuity of service. It also provides us a lot of independence in our business model. Mark mentioned that we have no proprietary products. We're not offering manager conferences or taking any fees from managers that might get in the way of just doing great research for great clients like you. So that's our business model. It's very important. We also alluded to the fact that my job is ensuring the right resources are brought forth for our clients like you. You'll notice at the bottom of the page, we have a 5-to-1 client to consultant ratio. My goal is to keep that less than 6-to-1. We've got ample capacity with the team in front of you today, but I'm not going to load them up with dozens of accounts and have them running all around the country, not answering phone calls in a timely manner. It's really important that they're responsive to you and, in fact, proactive to you. We only serve about 160 clients, over $1 trillion in assets. That means we have a very dedicated focus on our clients. We're not running around servicing a lot of small clients either. This business model, this focus on service is what's driven a lot of growth. We're really proud of that national footprint that's continued to grow in the public pension space, and in particular with Mark's leadership on the East Coast and Samantha's leadership in the Midwest, and we're continuing to grow that. You can see a sampling of our clients on the following page, some logos there. On page 5, we're really proud to work with the state and municipal plans. You would be in great company. Mark's alluded to a lot of the challenges and unique approaches these investment programs have, and we've experienced working with all of them.
Okay, so on the next page, before we dig into the recommendations for the portfolio, we believe that there are 3 things that you can do to really hit that 7.3% actuarial rate. The first is by modifying the asset allocation, so reducing risk and optimizing diversification. Next, we think that you can increase returns through modifying or enhancing the portfolio structure through active risk budgeting. So what does this mean? This means using asset classes that are attractive from a risk and return perspective and structuring them correctly, or enhancing that structure. And lastly, we'll use manager selection in asset classes where it makes sense, and that's very important, but I'll touch on that a little later. On slide 7, this is where we have provided some analysis of your current IPS relative to an alternative discussion portfolio. And this is a discussion portfolio because we do not know all of your products. And so this is something that we will find out during that enterprise risk tolerance assessment that Mark alluded to a little earlier. So in lieu of having that information, you'll notice at the bottom of the page, we show the various portfolio. And you'll see that the forecasted return of the alternative portfolio is slated to hit that 7.3% target relative to the current IPS or the current strategic asset allocation. And we're doing that while taking lower risk. So how were we able to do that? So there has been a modest increase to private equity and private credit in the alternative portfolio. But it's very important for us to know that you can take on that liquidity risk. There's some clues that we have right now that you can. Part of that is your current funding policy with the RRP, and those excess contributions are making the plan cash flow neutral or positive, 0 to 1%. And so this means that you can take on some additional liquidity risk, but we also need to test that quantitatively. And we can do that through a tool we created called the liquidity coverage ratio. And what that does is it stress tests your cash flows exactly in the same way the Federal Reserve is testing our nation's banks. So this is a very rigorous and sound way to ensure that you can take additional risk. Risk of liquidity risk, not absolute risk. To the right, you will see that we ran a risk analysis on the portfolio. You can see in most of the scenarios that the alternative portfolio is outperforming the current portfolio. And a lot of that is especially in large equity market drawdowns. On the next page, I will touch on portfolio.
I just want to talk about this page a little bit. Can you talk about the cash recommendations and how that relates to our benefit payment structure?
Yep, so we know that you are currently using cash in a strategic fashion. Part of our analysis in that liquidity coverage ratio would be to analyze to see if you need to have that 2% cash in the portfolio as a strategic target. So that's something that we would go through with modeling your cash flows.
And how would that affect the forecast return if you look at it and said, oh, wow, you really do need some cash?
So if you did need some cash, it would slightly change the alternative portfolio, most likely. So we're looking for those asset classes with attractive risk and return. Most likely, we would have to further increase the allocation to some of the liquid asset classes. As you can see, if you look at the box on the lower right, you'll notice that the portfolio, because we're increasing the allocation of private credit, we're using multi-asset credit, that there's some more additional interest rate sensitivity in the portfolio. So we would want to ensure that we're balancing that, although we don't see, the Federal Reserve increasing 200 basis points plus from this point.
You talk about changing, so we're a little less liquid. Is there a tipping point there where you think, okay, it's too far?
So, and Mark can add on, but so it depends. So we have clients that have a range of allocations to private markets. I work with a client that recently increased their liquid exposure to 46%. So pretty high relative to even some public plans, and they're actually cash flow negative. So unlike you, they're in a worse off position, but through our testing, we found that they can take that additional liquidity risk. So it really just depends on your cash flows.
If you think about it, probably the worst time for private equity was during the global financial crisis. And you saw a lot of funds that had heavy allocations to private equity became forced sellers during that time. Not necessarily because partially because they had to rebalance and raise cash to fund spending needs, but also because their future commitments were going to be excessively high based on their current asset base. So I think that's something, as Sam said, we have this liquidity coverage ratio test that we do where we stress test the portfolio to really see how it would look in the worst case scenarios for both public and private markets. And to make sure that we want to have ample buffer room to make sure you have plenty of liquidity in those kind of situations.
And it would include any sort of like pacing plans that the private markets consultant has, so it would include that analysis too.
Sam, on page 7, you recommend, to make sure I have this right, an 11% increase in credit investments.
An 11% increase. So the current way your portfolio is bucketed, there are some core or investment grade fixed income allocations, and then there's this bucket called opportunistic that includes like high yield, EMD, I believe, et cetera. So with multi-asset credit, that's what's causing some of the underperformance in regimes where interest rates are increasing. So we would be increasing your credit exposure on the public side through multi-asset credit as well as through private credit.
So take us from 1 to 12%.
Yes, but there are some current exposures of credit in your portfolio currently.
I think some of them are
It's-
legacy investments.
Yes, and they're just bucketed differently, yes.
Do y'all use AI to help develop any of these strategies? How much of a role does AI play into your decision making?
We currently are not using AI to model portfolios, but this has been an initiative of Shelley's, just getting us to use or utilize AI more for tasks like emails, et cetera. But I'll let Shelley talk to maybe some of the future plans for AI in our business.
Yeah, obviously the industry is carefully evaluating it. Investing and modeling is very much art and science, and we've never been the firm that has let the computer or an optimizer tell us what the right asset allocation. We bring in senior, seasoned, capable investment professionals to work with you to judge what should we consider as appropriate for this portfolio, and then what are some reasonable constraints around that. So in short, no AI and probably no AI in your asset allocation modeling anytime in the near future.
Right. We're doing a lot of work with money managers to understand how a lot of the quantitative money managers are now using AI. So we want to understand how that impacts both returns and risk within their portfolios.
Okay.
One other thing on this question on private, you started increasing private equity. Can you talk to us a little bit your thoughts about fees and balancing fees and returns and how you see that?
Yeah, I
Want to
think
go ahead.
kick it off. So that is, throughout this presentation, you'll see that there is a focus on fees and maybe changing the portfolio structure on the next slide to sort of optimize what you can do with fees. So for instance, there are a lot of active managers in the portfolio. Most of them have performed well. But at this point, it could be possible, and this is, you can actually turn to page 8 as well, just to see what I'm referencing. But it could be possible to maybe mitigate some of the overlap in the portfolio and then increase exposures to those managers who are really doing well and then drive down fees. Even if you were interested in maintaining all of your current managers, you could still put them on a performance fee schedule so that you're not paying them if they're not producing excess returns over their benchmark. Because we're reducing some of that exposure to public equities, moving that over to private equities, and doing some of that with fixed income as well, we really think that by not necessarily taking an equal weighted approach to all of your managers, you can drive down fees on the public market side to make up for that on the private market side. And Mark,
No, I was just going to say, I think, and I don't want to get the impression, we aren't blindly recommending, we don't think there's an illiquidity premium that you magically get by investing in privates. Obviously, we know that you have to be very meticulous both about identifying top performing funds as well as negotiating fees and getting those down to a fair minimum. If you look at the dispersion, you've probably seen this in the past, but the dispersion between the top quartile and bottom quartile private equity fund can be as high as 2,000 basis points. Whereas, in public equities, that's a very narrow spread. So the real critical thing is getting the right funds into the portfolio and then getting the fees down as far as you can.
Thank you.
Okay, so I already touched on a few of the points on slide 8 in my last response. But I'll note some of the other things. Or the last point on this page, you can see using active fee dollars efficiently. And so every year, Veris produces research that shows where active management works on the public market side. And this is public, it's on our website, et cetera. So for instance, we know that you have global minimum volatility strategies. Within equities, we want to make sure that your equity portfolio, which is the main source of growth, is running on all cylinders. And if you look at your global min-vol returns, they're just lower than global equities. And that's because those managers are truncating risk or reducing risk, but they're also reducing return in one of your highest returning asset classes. So we would want to modify that and maybe just find a global equity manager that can add value over a global min-vol. And then in emerging markets, you currently take a passive approach, but our research shows that you can still find alpha or those excess returns in emerging markets equities. So that could be also something that you could explore.
Great. I want to do a time check, and I think we're hitting about the 20-minute mark. So, just want to make sure it wants to.
We're on. Wrap up in 5?
Okay.
We have some other questions.
No, we appreciate the questions.
So I'll just touch on 2 things that I think are extremely important. And I'll move to slide 10. So here you can see our manager research leads, our team. They're very senior, very stable, and very experienced. Each of the research leads have been at Veris for at least 10 years, and they also have a very diverse set of experiences. So Marianne Feely, she actually worked abroad in Australia as a research analyst. Faraj Ushani, he's our private markets lead. He actually sat on your side of the table for a California endowment. Paul Presselmeyer, that's liquid alternatives or absolute return hedge fund type strategies. He actually managed fixed income assets. And then Ian Toner, he is our CIO. He kind of brings it all together, and he ensures that we do it in a very transparent and academically based way. On slide 12, I just want to point to the success of having a very stable and experienced manager research team. So here we show a chart of our high conviction strategies. So you'll see IQ2 and IQ1 rated managers at the bottom of the chart. And more than 84% of our high conviction strategies have outperformed over the past 5 years, which means we don't expect to have to do 1 million manager searches or bombard you with manager searches. We hope that when we find a manager, we can really stick with them for the long term. And then I will turn it over to Mark to close.
Yeah, let's just jump to slide 15 and we'll close it out there. And as I said at the outset, ultimately our role is to deliver results for our clients, and we believe we've done that historically. If you look at the chart there, you can see that 2/3 of our clients have been with us for over 10 years, and over 1/3 of our clients have actually been with us for over 20 years. And they give us really high marks. We've had an independent survey firm come and survey our clients on things like responsiveness and client service and portfolio knowledge. But it's more than that. It's really a culture of managing risks. We manage risk on an absolute basis as well as relative to benchmarks, liabilities, and peers, if that's a preference of our clients. It's a proactive approach to working with clients. We're going to provide you with our best thinking. But that said, we're humble enough to know that we don't have a monopoly on good ideas. So, and I know you checked our references. I think all of our clients would say that we work with them on a very collaborative basis to bring the best ideas into the portfolio, whether they originate with Veris or whether they originate with staff or someone on the board. We are open to working with you in that way. And I'll just close by saying that we'd be very honored to serve the city of Philadelphia, Board of Pension and Retirement, and not just Sam and me, but really our entire firm would view you as a very, very important client to us. We ever get a chance to work with you.
Thank you very much.
Thank you.
Any more questions?
Just one more quick.
Yes.
The Willow Research, are you general consultant, private assets, or real estate, or?
General. They have dedicated private, a different consultant on the privates. And we were just hired, we were hired originally as a board consultant during their tumultuous time before, well, after it happened. They brought us in to help.
Yeah.
And then they hired us as general consultant a little over a year ago now.
Very quick, because this is my thought, I don't want to talk about it if you leave the room. I like some of your suggestions, kind of putting the foot on the gas a little more, right? Private equity is our best asset class, right? Cash, global, miles, sort of weight everything down. However, a pension fund, to get to our target, you don't want to go from 0 to 15 to 0 to 15.
No.
You want to stay between 7 and 8, to oversimplify it, go 7 and 8. It's more productive over time,
Right.
which has been what we've done. So your suggestions of what I'll say, eliminate cash and to maybe put a little more in private equity, which has a lot more highs and lows, as you noted. Can you speak to that? Because that's my concern.
Yeah.
So I don't want to talk about it with you out of the room.
No, I appreciate the question, and as Sam mentioned, we have clients that have as high as 42% allocation to privates now. And again, we don't blindly allocate it to privates. We recognize that you really have to be able to identify not only managers that are generating strong returns, but managers that can manage risk and manage liquidity, and all of those things come along with private equity. If you noted, and Sam didn't have a chance to get into it, but you saw we actually, our portfolio, and I want to emphasize it's not our recommendation to you, but that's a portfolio we wanted to discuss to kind of directionally give you kind of an idea of how we think about things. You actually reduced your overall equity beta in that portfolio because we were adding private credit, we were adding private real assets as well. And so you have, that helps balance the risk in the portfolio. So that's, if we had a theme, it would be more balanced risk across the portfolio, not relying so heavily on equities, but we're relying on other asset classes like private credit, infrastructure, et cetera. Private equity, and we model it. We don't model it. As you know, private equity has kind of muted return streams when you look at it on your performance statement or on your balance sheet. We don't model it that way. We treat it like we have pretty much double the risk assigned to private equity as we do public equity. And it's everything else working together that allows you to make that allocation and still reduce your overall volatility in the portfolio. As Sam did say, the thing at that point where you really need to be cautious about is your liquidity and making sure you have liquidity to pay your benefit payments, to rebalance, to do everything that you need to do as trustees of the system.
I have a question. Could you talk a little bit about your commitment to diversity and your hiring practices and where you are, or targets and goals you have, as well as your commitment to communities in terms of giving back?
I can kick it off. So we just didn't have time to touch on it a little earlier. But there are 3 prongs that we have on this slide, which is our commitment to diversity. So Shelley, not to brag on her, actually founded the IIBC, which is a consortium of consultants who have come together to try to increase the transparency within the manager search process. So Shelley worked very closely with eVestment, which is an institutional database, to bring that transparency, not only at the firm level, because that's honestly what we all hear about, over 50% diverse owned or women owned, et cetera. Really focusing on that investment team and who are the people making those decisions, because if you have a diverse investment staff or diverse portfolio managers, that's their training, even at a majority firm, so that they can make enough money to start their own firm. It's interesting, one of our clients a few months ago was going to commit to a real estate fund, private equity real estate fund. And the manager, she was raising assets, and her partner, her majority partner, kind of pulled the rug out from under her. And so our manager, we literally just came to the board saying, we're making this $10 million commitment, but we had to pull it back and wait for her to start her own fund, which she just announced a week ago, a partnership with TPG. So these are like the ways in which we're working with clients and trying to bring that diversity to them. Shelley can talk about within our firm and what we're doing, but I'll just touch on the diverse exposures and how we're using diversity in the due diligence process. So we have an open door policy all year where we do meet with diverse managers. 1 out of every 6 meetings that we have with managers is actually with diverse or emerging firms. But we also host an annual event for emerging and diverse managers. It has a webinar first, and then we have dedicated meetings, because sometimes you can just have an event, but those managers aren't really speaking to the people that they need to speak to get rated, to get on the platform, to get assets. So we have one-on-one meetings with managers, both consultants and research. But we're meeting with those managers throughout the year, and we see lots of interest. I think we typically meet with 50 firms over those few weeks.
Yeah, just to add on to that, our database has over 400 diverse products, so we continue to add to that database and are making sure that we're investing in cultivating those. Sometimes they may not be quite institutional quality for our clients, but instead of saying no, we try to lean in and provide them some advice and support and network to be able to grow into that institutional quality. With respect to our firm and our recruitment efforts, we continue to recruit broadly and focus on diverse recruiting networks. We have continued to grow the diversity of our firm. I'm really proud of the diversity of our firm. Of our firm-wide staff, nearly 1/3 are Black and people of color. 27% are women, and we know we've got some more work to do, but we are really proud that we're above our peers as reported by DAMI. So we continue to work hard on that. Our ownership is diverse, as I mentioned, 35 different shareholders, and many of them are those same people that I referenced. So happy to answer any other questions on that.
Thank you.
And give it back to the community that was.
Yes, right.
Well, certainly, we're actively engaged in the communities that we live and work in. We think our efforts around diversity, particularly as Samantha mentioned, we are gatekeepers. The consulting industry is a gatekeeper to asset owners like you. And so we have an important role to play across the asset management industry and making sure they are executing effective and healthy recruiting practices and growing diversity within their firms. That creates the economic wealth. It can't just be at the shareholder level, it has to be at the investment team level. And that does translate selfishly into the returns too. We believe those investment team members are going to generate returns. So we're focused on, at a firm nationally, helping to make sure that the asset management industry is playing their role. And then in the communities that we live and work in, we are actively engaged. So for example, in Seattle, there's a program called Rainier Scholars that's focused on individuals in the high school program, inner city in Seattle. And so we take an intern from there every year, and we are sponsors of it. We're doing similar things in all of the cities that we live and work in.
Anyway, so we have some young guests here.
I know.
Yeah, the same thing. That's why
We came up on the elevator.
Yeah. Because it's important from an exposure perspective that young people, if they haven't been exposed to it, they don't know the possibilities in the area of finance. And so one of the things we always think about is how can we get that exposure out there? How can we partner with colleges and universities and HBCUs to really get that message across so that people know that there are things other than outside of finance, that accounting, people always think of accounting, number one, top of mind.
Not that there's anything wrong.
No, not accounting, but other opportunities and exposure. So that's kind of the way I always think of it.
It's funny you say that. So a few weeks ago, there's an organization called the Greenwood Project. So think of something similar to like Rock the Street, Wall Street that they have in New York. And they had an event where they invited investment professionals. So there were some from like Northern Trust, because that's big in Chicago. I was there. There were a few other investment professionals there, and we hosted like a group of students, like probably about the same size as the board here. And we were just like talking about our experiences in a very, raw way is what I would say. And just let them know like what to expect when they get into the industry. One of the students actually like lived on my block.
Oh, wow.
Which I don't know if I should be living on the same block as a student. But yeah, but like we have the same tailor and maybe he makes more than I do.
Parents.
Yeah.
Talk to Lisa.
So yeah, we're pretty active.
Any other questions about neighbors or?
Thank you.
Well,
Thank you.
very much. Thank you all. We really appreciate it.
Thank you.
Ready? Everybody ready for?
Yep. Just gonna fill my coffee as they set up. 30 seconds.
Good morning again. Hey, long time no see. Way too long. Sure, absolutely.
I got another.
Oh, Chris.
Oh, can you send that to me?
Sorry. You just need 3.
Okay.
Should we go?
Have it.
Let's just go. We'll go out further.
No, that's good.
You have a couple minutes to figure it out.
We know it's in the president.
This is how we saw our asset allocation.
Yeah, I do.
Okay. So I got 82. I probably said that, and I just.
Are you joining us on y'all coming down to the soccer match tomorrow, yourself, Dominic, and
Yeah.
Judge Thompson?
Get a sense of how it's different.
Oh, yes, it's rowdy though. More so than football.
Even Eagles football.
Yes, yeah, I really, that's hard to say, but
It's hard to see.
it can be more rowdy. Doesn't mean bad, I mean, we have to be honest. I don't feel like we have as many problem calls for soccer.
Yeah.
It's just more rowdy. You're a little more on alert.
And that's my.
This is a, these are big football, I understand. Really big.
The Liverpool
This is
Arsenal.
the biggest.
Liverpool is the biggest club in America, from that region, so.
I know this way we started on soccer.
It's called football.
See what happened in Miami?
Yeah.
It's crazy.
Oh, wait for Christie.
Where's Christie?
Oh, okay. I thought you wait for Christie. Where's Christie?
Christie is here.
This is high.
Oh, you hiding?
Behind compliance officer.
Yeah.
Y'all gotta make your votes.
Oh, no, we got two.
Okay,
Yeah.
Y'all got 10 minutes.
So, 20 minutes or until the first person will roll off, whichever.
Absolutely, 20 minutes is reasonable, and we have a very short presentation to get it done. So we're ready to start whenever.
We are ready.
Okay, well, great. First of all, before we start, we do want to start with a very sincere thank you. Over the last 8 years, I think you'll see in these pages a very good real-life case study with respect to strong governance, a lot of communication between staff, the board, and the consultant, and asset allocation that has worked both in down environments as well as up environments. And really the proof statement will stand the discussion weekly. So we'll discuss that momentarily. But really quickly, introductions. So Quaker a bit very quickly. I come with 25 years experience, and as we think about Marquette as a firm, it's definitely evolved for the better over the last 8 years. I represent part of the leadership of the firm as a board member. That's not figurative, it's not symbolic, it truly is leadership, whether it's from ownership and having a seat at the table. I'm also joined by another leader within the firm, Dave Smith. Again, through the great work we've done in Philadelphia, we've been recognized nationally for some of the good things that we have been able to partner with this plan on. And with that, I will turn it to Ms. Haley to introduce herself.
Hi, everyone. I'm Haley McCollum, and I work in our private market research team at Marquette.
Vice President of Client Service at Marquette. I'll be like the day-to-day contact, anything reporting. I'm the go-to guy for that.
And then Dave Smith, part of the consulting team, like Quaker, I'm also on the leadership at Marquette.
Nice to meet you. So to page 3 very quickly. I think in this industry, numbers are great, right? But one of the good things about this business is deciphering the numbers. What do the numbers mean? And roughly 11 and a half years ago, I made the decision to leave the biggest investment consulting firm with trillions of assets under advisement for Marquette Associates, still a very large firm. We're in the top 13 in terms of investment consultants. But the reason for that was truly this barbelling that's happening in the industry. The art and science of consulting, particularly with the larger firms, I witnessed this firsthand, began to go away. The economics of the business do push larger firms to creep in the money management space, creep into, even if they are independent, there's elements of advisory and analysis that do push the newer, more dynamic things in a portfolio. We're more about stability, thoughtfulness, and building an asset allocation that's customized to the client. So really joining Marquette was a deliberate decision to re-enter the world of consulting. In terms of my start in the industry, I started out in asset management, and asset management gave me a first foray into that skill set, which is very different from the consulting skill set. So Marquette, very proud of the fact that we're close to 400 billion now with new counting numbers. 38th year in the business. So we've definitely not been doing this, since last week. This is a core business of ours, 100% employee owned. Dave and I do represent part of that ownership. And as we think about other individuals at the table, as we think about retaining and really engaging other colleagues, Dave and his colleagues at the executive level, they've done a really good job of creating a principal track. So the goal is over the next couple of years to continue to see other promising colleagues join the ownership ranks. We have 140 plus colleagues, 5 office locations, including 1 in the Philadelphia suburbs. Client retention ratio, which is critically important. When clients do work with us, again, we're very custom. We want to make sure that we're that expansion of staff, and we're also reporting to the board in that predetermined fashion. That really is a key component of what we do. And on page 4, you'll see that publics do represent a significant portion of our business. So another reason why I did leave the prior firm was a business decision that literally happened overnight. You probably heard many different stories, but they ended up leaving public funds. And that was a decision that really, opened my eyes to the fact that, look, not every consulting firm uses clients the same. Not every consulting firm will leave and go the extra mile for their clients. And again, the culture of Marquette has really been one of making sure we understand the clients, we put the clients first, we're able to have those difficult discussions, and it's not just about coming in and overhauling things for the sake of overhauling things. It's making sure that we're being very deliberate, very thoughtful with our approach. Page 5 just takes us to East Coast presence that we have. So again, we're a national firm, so a lot of exposure across the country and some significant exposure in the East Coast, particularly in the Pennsylvania region. We have colleagues that have done an exceptional job with respect to lifting the Marquette brand in this particular market. Page 6 takes us to our ownership structure. And here, really want to stress that this makes us unique. In this environment, we continue to see more consolidation, hear about more potential consolidation. Larger firms, once you reach a certain point in your size and scale, again, you're going to have to dabble in certain things to diversify that business model. We've stayed very true to our cooking, and ultimately, our job is to be a consultant. We're not a money manager. Our job is to get the asset allocation right, and really based off that asset allocation, have a risk and return profile that's in line with what the client is expecting to see. Page 7 takes us to ownership structure. So the takeaway here is we have a number of partners at the firm, with 25 and counting. And again, as we think about the future of Marquette, the future of Marquette is in the hands of the individuals at the table, as well as some of our other partners, or I should say some of our partners mentioned here. And again, that independence has truly allowed us to carve out a niche that's very different from our other peers in the industry. Independence means that we're more strategic. We're not owned by private equity, meaning that there's not this underlying pressure to suddenly sell or create lines of revenue that aren't organic to how we're seeing the business evolve. Page 8 takes us to our client service team. With respect to the age of the client service team, and my kids always remind me of this, I think I'm young and dynamic and hip, and I know all the language of cool kids. They tell me I'm not.
I saw him at the airport, he was wearing a Public Enemies t-shirt.
And that's like sweet screw. I was so on.
Were you with your kids?
I missed them, sorry. But as we look at the years of experience, between Dave and I, that's 50 years of consulting experience. Again, we think about the importance of experience, we think about the importance of delivering service to clients, and that experience between the two of us, I think, is a testament to the thoughtfulness around the servicing and the discussions we have with staff on the board. We had Greg Leinberger, our credential actuary, that's suddenly 75 years of experience. We had Nat, that's 95 years of experience. We had David Hernandez, we had Jessica, Chad, Haley. Suddenly we're at, 120 years experience. So this is a pretty experienced team when we think about the depth of knowledge and discussion and efficiency that we bring to the conversations. And on page 8 on the right-hand side, I think this is a true, proof statement. I would say that we have, over the last 8 years, consistently discussed trends as well as observations in the public space. I think over the last 8 years, we have definitely focused on the risk-adjusted returns, both in exciting markets as well as more benign markets, and then customizing the investment strategy. In a moment, Dave will dive into our philosophy, thought process, and then we'll talk out the numbers, the proof statement. Again, we live and breathe this. This is important for us. We are owners in the business. There's always that saying, no one ever washes that rental car, and that's a true statement. There is an element of understanding, passion, pride, and care that we bring to the table, and like the fact that if our clients succeed, we succeed, and that's literally as simple as our business model. So with that, Dave, I'll turn it to you.
Yeah, and I think, as we discussed at the meeting earlier, and as we'll review in just a few minutes, what we're doing together is working. And part of the reason that it's working is because we have a thoughtful, collaborative relationship. We have thoughtful leaders, we have thoughtful board members, thoughtful staff. We share ideas, we listen to each other, we study, and then we make good decisions. And all of that is possible because of the relationship that we have. And we think back to our early years in investment consulting school and the types of clients that we aspire to serve. It's clients just like this, the ones that are engaged, the ones that do have their own opinions, the ones that want to do the right thing for the underlying beneficiaries. And it's incredibly rewarding to us to serve a client like you. To underpin some of those key themes, hopefully we demonstrate our humility at every single meeting. We're skeptical, we're honest. And what that means is developing the right strategic asset allocation to align with your unique risk return characteristics, driving down fees, and hiring high quality managers to implement the vision and the strategy that we've set forward through our modeling, through our study, through our stress testing. And just to think about what stress testing and asset allocation means, asset allocation, which is something we review every year along with stress testing to make sure that we understand the blueprint, the path forward, the long-term vision for what we hope to achieve. And we also recognize that there are bumps in the road. There will always be bumps in the road. We never want to be caught flat-footed. And that's what the scenario analysis allows us to evaluate. What happens when interest rates spike? What happens when equity markets collapse? And we know they will. Everybody around this table has seen that before. So we want to understand what will happen in the portfolio so that we can be prepared. And then part of conducting or constructing an asset allocation is being thoughtful around the fees that we're paying. We want to make sure that we're constructing a asset allocation that allows us to achieve our risk-adjusted return. We also want to use our active management budget responsibly. The one thing that we can control with absolute certainty is the amount that we are paying for investment managers. So constructing fee-efficient portfolios with the right balance of active and passive management allows us to drive down costs. And all of that savings goes back to the portfolio.
Can you talk a little bit your thoughts on liquidity?
Right, so we want to make sure that we always have adequate liquidity to make any sort of beneficiary payment or adjust for any sort of unexpected short-term cash flow, which allows us, or is part of the reason we need to have allocation to public markets and not just equity, but fixed income, so we can source liquidity when markets gyrate. But we also recognize that an illiquidity premium is an important part of a return driver. So balancing that need for liquidity with an illiquidity premium is part of the thoughtful asset allocation analysis.
And how do you determine what that trade-off is, where you continue to illiquid? I look at that too.
Yeah, so I mean, part of what we're able to observe is the amount of the monthly drawdown, the amount of the annual drawdown, and we can set parameters in place to be more conservative. It could be 2x the maximum expected drawdown. We have such rich history and have been able to observe over such a long period of time. We have a good sense for how much liquidity is needed under even the most dire circumstances. But that, so part of that is related back to the asset allocation, and that's what we visit on an annual basis. What is the mix not only to asset classes, but to a liquid and illiquid asset classes? Thanks. So in terms of the convictions, and we have been stable, consistent, and steady with our investment convictions. And just to highlight key themes, being duration neutral, not taking a sizable duration or interest rate sensitivity bet. And we have been in an environment where interest rates have fluctuated wildly and unexpectedly, very difficult to predict. So we tend to be duration or interest rate sensitive neutral, meaning that we're not overly exposed, but we do have active elements of active management to capitalize on trends in credit, trends in the securitized market. So we have active management around the edges. Same with the equity portfolio, being thoughtful in our approach to passive management to drive down costs, and active management where we think we can source excess return, small cap, our US small cap is an example. And then lastly, alternatives, and Rob, back to your question, this allows us to really source persistent sources of alpha. Granted, we are trading off some element of illiquidity to achieve that level of growth. And that is part of the ongoing balance, understanding our liquidity needs in concert with what we can allocate to illiquid markets. And just to underscore some key themes, having conviction in our investment themes helps us to weather very unexpected market conditions. And the one thing that we can absolutely count on is unexpected market conditions. We are operating in an environment with an inverted yield curve, the longest ever in the history of yield curves and the history of conversions, 2 years. Normally, this signals a recession. Well, certainly that hasn't been the case. We've been able to navigate a very thoughtful and constructive fixed income portfolio that's capitalizing on higher yields. Same thing with public equity markets. We've been operating in an environment where U.S. equity has outperformed non-U.S. equity for a significant amount of time. But part of the reason that we have a diverse allocation between U.S. and non-U.S. equity is to remove or mitigate some of the concentration risk. We think about the Magnificent Seven, 60% of those companies, they're the largest companies in the S&P 5 are driving 60% of the S&P 5 return. We have huge concentrations in IT and communication services, but by virtue of allocating geographically, we're able to bring those concentrations down. Non-U.S. equity tends to be more evenly diversified or have higher allocations to market signals. And at some point, we will see that pullback, and perhaps we're starting to see some of that in the second half of July as the markets are rotating from very rich, very overvalued technology stocks. And then finally, real estate. Real estate, of course, has been the area of disappointment in the portfolio since 2023, but it's also been the key source of support in a market where we saw equities and fixed income decline significantly. U.S. equity was down 19.5% in 2022. Fixed income was down 13% the same year because interest rates went up so quickly. Real estate was the ballast in the portfolio. And if we look at the chart on 18, there have only been 3 years out of the last 24 where we saw negative calendar year returns. 2021 was up 18.5% just in the portfolio. 2022, when most markets were down, was up in positive territory. This is emblematic and evidence of the importance of diversification, and a diversified portfolio will experience drawdowns in some asset classes. So just to bring it back, asset allocation really is the most important driver. That's why we focus on it. That's why we evaluate it each year. We don't necessarily need to make changes, but that is one of the single most important things that we do together is think about asset allocation.
And with that, 8 years ago, it's amazing how time flies. 8 years ago, we sat through and went through this particular exhibit talking about asset allocation being the driver of the risks and the returns that we wanted to take in the portfolio. Page 20 takes us to exactly where we were. So I think perspective is always important when we look at numbers. And the numbers, again, we're really looking forward to walking through these. The first bullet point on page 20 talks to, while there are many different ways to increase the expected long-term return to the portfolio, staff, Marquette, and the board determined a path that was viewed as prudent, transparent, and in line with the board's risk tolerances and fee sensitivity. So the takeaway here is there's absolutely a number of different ways we could have gone to the target rate of return. But as we came to the table 8 years ago, the board was very candid with us. It mentioned that, over a couple of years, it looked to take a different direction in the portfolio. It realized that that direction was not ultimately where things wanted to go. So we wanted to make sure that the asset allocation did the opposite of what we discussed at the table. We saw an asset allocation that captured too much downside when the market went down. We saw an asset allocation that didn't capture the upside when the market went up. So again, in devising the asset allocation framework, we were very sensitive to those pieces of feedback. And as we spoke about the different mixes, we put forward an allocation that reduced exposure to hedge funds as an example, MLPs as an example. We went really boring, went with open-end real estate as opposed to closed-end. Where we were in the cycle just made perfect sense at that point in time. Using the risk budget, knowing that you had an excellent allocation, healthy allocation to private equity, that allowed us to acknowledge a target rate of return that was at 7.65, that was also ratcheting down, and also with an allocation that expected to receive cash injections. So the takeaway here was to be very thoughtful, not have an academic portfolio that just has all these exciting things, because at the end of the day, we don't need to re-risk. The reality of the portfolio was, let's be very thoughtful about the risk that we're taking. Now, page 21, this is the really cool stuff. This is the proof statement. So the very first line here, you're going to see the portfolio as of June 30th, 2016. So this is when we sat down and we were talking about the portfolio. If we look at short-term returns are under the index, long-term returns are under the index. we have 100 basis points differential over the 3-year versus the index, 200 over the 5-year, 120 basis points over the 10-year period. What's in the proof statement to a strategy that's working? That proof statement is moving in the direction that was set. If we look at the end of June 30th, 2023, and there's even better numbers to come up, June 30th, 2023, all of a sudden, we're looking at positive returns relative to the index. So we've controlled the tracking error. Shorter term returns are keeping up in line with the index. In addition to shorter term returns keeping in line with the index, we've consistently seen stronger performance. You guys get the weekly updates. The weekly updates don't show much in the way of surprise in performance versus the index. That type of consistency led to, over the 5-year, the tracking error shrinking to 60 basis points. So it went from 200 basis points to 60 basis points. Over the 3-year period, we actually went from 100 basis points differential to being over 10 basis points. 10 years, we went from 120 basis points to 60 basis points. So again, the deviation from the index over the long term has shrunk considerably, and that is a proof statement of a very consistent portfolio. We've seen up environments, down environments, and we've seen the portfolio do what it's supposed to do. Now, page 22 takes us to the returns as of June 30th. Even better results. So for the 1 year, we beat the target rate of return. For the 3-year period, we're still over. We have a 30 basis point differential over the index. And then over the 5-year and 10-year, we see a 10 basis point differential over the 5-year mark. When we first started out, with 200 basis point differential. So again, asset allocation drives the returns and the risk of the portfolio. Over the 10-year period, we now have a 50 basis point differential versus the 120 basis point differential. So an improved performance stream over the long term, improved performance stream over the short term. We go back to the objectives of the portfolio, objectives of the portfolio. Objectives of the portfolio, in our opinion, have been met. So very, very quickly, composite returns. Well, I'll pause. So I heard the alarm go off. I want to be very respectful of time. We can pause here. The takeaway from this exhibit is in up environments, the portfolio has outperformed, and down environments, the portfolio is protected on the downside. We've had some very thoughtful discussions at the table regarding asset allocation, and when all is said and done, the objectives of the portfolio, I think that's something that everyone in this room can be proud of. We've been pushed to really, really defend, discuss, monitor, dissect what's in the portfolio, and the statistics are here. The numbers do not lie with respect to the experience that we've had with the asset allocation. And then finally, page 28 takes us to the asset allocation. We continue to be mindful of the asset allocation that was approved during the 3rd quarter period. During the 3rd quarter period, you'll see here that we approved Mix B. The target rate of return continues to ratchet down. We've been able to do this by maintaining liquidity in the portfolio. And with that, we'll conclude our comments. Thank you.
No, let me stop. Question.
Sure, absolutely.
How does, if it does, AI play a role in your firm as far as selecting asset allocation or managing things of that sort, if they do?
No, so.
It's all the AI.
That's all the AI. How much insurance do you?
That's the question. That's the answer.
That's the answer.
Yes.
Not at all in your firm at all, you don't look at AI at all.
No, so I would say that AI, whether it's ChatGPT, and Chat is not here today, so that's the abundance that we have. Chat is a hologram method research, but aside from that, Joe, I would say that when it comes to new technologies, when it comes to new innovations, this is an industry that doesn't shy away from embracing those things. But this is also an industry where being old school is not a bad thing. Sometimes being a little too ahead of the curve is not necessarily the right thing. Being independent, and again, this is the experience of not being part of an insurance company or by a private equity company, we can really assess what's in the best interests of our models going forward. Right now, the approach that we're using, the results can seem to be in line with our expectations, client expectations. But that's not to say as time goes on, if there's a more efficient way to do something, we'll absolutely look to adopt that, but at the right time versus trying to be the first adopter and then first adopters, it's nice to watch first adopters from afar. I think that's the best analogy to give.
We talked a lot about the asset allocation. What would make you think, you know what, we really need to shift?
Yeah, so if, for example, the Fed was to jack up interest rates, right, in 2025 rates go up, I think that does call to, okay, this is a little different. What's caused this? Is it reinflation? Are there other projections that somehow we're not gonna, benefit from? Presently, there isn't anything in the asset allocation, and it's not from complacency because I would say every month we have really good discussions at the table. Between those discussions at the table, we have really good conversations with staff, essentially asking us why we're not looking at certain strategy or manager. So this asset allocation here is the result of, again, taking a look at the path that was laid out. Is it effective? Is it working? And right now, because it's not broken, we believe we don't need to fix it because right now the most likely scenario right now is rates going down from the Fed. The most likely scenario right now is in an election year, the stock market rallies. Statistically speaking, these are things that I'm not just saying. The stock market typically rallies during an election year. When we think about where we are in the cycle, and to Dave's point, we've got an elevated yield curve. We've not seen a recession. We have the international markets potentially poised to outperform the domestic markets. We also have, on the private market side, there's so much dry powder, there's so much data being created that to re-risk the portfolio at this point in the strategy, we also feel that wouldn't be prudent because, again, the target rate of return is ratcheting down. We still have an asset allocation that gets us there. We're very mindful of fees. So page 30 really quickly, we didn't get to it, but fees went down. We were at 62 basis points on fees. We're now at 37 basis points. These are all considerations that have to be brought to the table when we think about the direction of the portfolio. So no changes are planned, but again, it's not because we have better things to do. It's literally because as strategic asset allocators, it's this fine balance of long term, this is where we need to go. Short term, there's going to be bumps along the road, and just recognizing whether those bumps on the road need the car to get realigned or not, or whether it's a short enough bump that you're still going down the path you need to. Right now, again, with rates going down, that's going to be a pretty strong tailwind in our opinion for fixed income, private markets, with the stock market position how it is. Even if there's a sell-off in growth, we have defensive pockets in the portfolio that would be expected to help us. So again, from every angle from our stress testing, the asset allocation continues to get reinforced by the scenarios we've gone through, the realized performance of the portfolio, and then again the numbers, which really don't lie, and the context behind the numbers tell a really good story.
So one of the things that is not included in your presentation is your DE&I strategy. Yes. So you want to remind us briefly about what that DE&I strategy is, not only from recruitment, retention, and also your community involvement. If you could just talk briefly about that.
Absolutely, and I'm sorry.
we know, Carol.
So I would say with our DEI, so firstly, we have evolved to a point where, as owners of the firm and as leaders of the firm today, the language, the approach, and the adoption of DEI, we don't just want to have numbers in front of you. So it's around 30% diverse in terms of the firm right now. That's a decent number, but it's definitely a flaw, right, with respect to that number. But we've kind of gone through this up and down in the industry where people show numbers, people show numbers, people show numbers. We've not seen the needle move. So outside of that, we are just going one step beyond, and we're partnering with institutions that are diverse owned and helping those institutions gain assets and build their base. There is a female African-American owned consulting firm that Marquette is strategically partnered with for that very reason. The goal there is to make sure that the endowment foundation space, an area of significant growth, the defined contribution space, an area of significant growth, and God bless the people in the public space. Public plan students have really lived in the tide for decades, but it's not fair to just expect public plans to over and over just be one source. So that's part of our solution. Our hiring and retention is also part of that. And me saying the stigma in public, again, as a partner in the firm, as someone that knows that I'll be at the table with you, we're putting it out there that this is what we're going to get judged on. So we're looking to increase the amount of assets we allocate to diverse-owned firms. We're obviously looking to increase the number of diverse-owned colleagues that we have. And ultimately, we're trying to move away from the corporate game of, I've worked at big corporations. You kind of understand how the rules of the game are played after a certain point in your career. Within Marquette, again, a lot of different opinions, a lot of diverse thoughts at the table, but it's still a firm where I have a voice. I have that voice echoed by other partners, including the president of the firm. And in echoing that voice, we're doing something pretty transformative in the industry. And we look forward to updates with you. So the firm is called Pivotal Advisors. That's the firm we're strategically partnering with. Tiffany McGee is the president and CEO of the firm. She's on CNBC from time to time, very dynamic individual. And again, we're putting our money where our mouth is by actually helping a firm get from point A to point B. And then we are providing, again, the back office, the solution, the infrastructure, along with the other things that folks are doing, whether it's the conferences, which are essential. Carol, Ms. Carol, you can say short, so I'm sorry. That was short for me. Very quickly, I will say that in terms of community involvement, I am on the board of NASP. So that's something that I volunteer my time to, the board on the PPPC, government service. Couldn't pick a better place to say government service is the right thing to do. So that's my part of my service and my obligation. Many of us as partners sit on committees outside of our day jobs. We have colleagues in Pennsylvania that are involved in local communities. So it's part of what we do. And ultimately, we're moving away from the corporate game, which again doesn't lead to the needle being moved, and kind of adopting more of the Philly special approach, which is like you kind of just do it. And if you do it right. That's a good story. It gets replicated, and that's as simple as it is. And we, at this point in our history of Marquette, we have the bandwidth to do it. We're doing it, and it's a very exciting time for us.
Any other questions? Great. Thank you very much.
Thank you.
Thoughts, questions, preferences? Yeah.
I make a motion that we retain Marquette.
Thank you so much.
Sorry, Karen.
That's good. I can hear.
And it is moved and properly seconded. Call the roll. Bill? Adam? Aye. Marcus? Carol? Billy? Brian? Paul? And Francois? Motion carries. Thank you very much. Any new business? Any old business? This is moved and properly seconded that we adjourn investment committee. We are adjourned. And to call the full board in session, is there a motion to ratify the actions taken in investment committee? So moved and properly seconded that we ratify the actions taken in investment committee. Bill? Aye. Adam? Aye. Marcia? Approved. Carol? Billy? Approved. Brian? Paul? Aye. Francois? I approve. Yeah. Yeah. All right. Any new business, no business, we're about to end your adjourn, and we are adjourned. Thank you all very much. I want to say,
Public safety comment.
Got today, I just.